Welcome, everybody, to JSS Podcast. This is Byron Enriquez, the casual executive, their resident finance bro. After 1 week off, Thanksgiving holiday, got a chance to relax, unwind, and reset a little bit. Hopefully, you guys got to do the same. Seeing how we end off the year and kind of flow into 2026. So today, I want to talk a little bit about just little bit of a recap of kind of some expectations that we had for 2025 in the market, 2025 in finance and money, and things that happened or didn't happen. Where does that leave us, and where? How do we position those situations for the coming year and put ourselves in a better spot, right? So, 2025 is an interesting year, right? If to say the least. There's been a lot of, in the political sphere, there's been a lot of different changes, a lot of things that have happened that have pour over into the finance world, into the real estate market. We've talked about tariffs, we've talked about inflation, there's been immigration situations, there's been lots of different factors that in one way or another have impacted our economy, have impacted job sites, have impacted mortgage rates, have impacted all the things, right? So it's just, again, it's been an interesting year, and doing some preparation for today's episode, just kind of reading some of the things and even some of the forecasts that I had for the year. One of the things that we kept talking about in 2024 was interest rates, right? We were expecting maybe second to third quarter of 2025 that we'd start seeing some downturn in mortgage rates, pretty big, and we were expecting half a point to a point discounts, which we didn't see, right? I mean, it was kind of a back and forth with the Fed and the presidency and all those things, and we didn't see the numbers that we were expecting, right? So how did that impact the market? People who one of the things we've been saying for a while is it's inventory right now is really, really condensed, right? Reasons for that is if somebody has a mortgage rate of 2.5%, 3%, they're less likely to put their house on the market and go buy a new house because they know that even though they're going to make some profit on their property, their new purchase, now they're getting it at 6.5%, 7% interest rate, the going rate. So that's limited the amount of inventory we've seen in the marketplace. Has impacted us a lot. Going into the summer months, we're usually expecting an influx of buyers, or inventory and properties to move, which didn't happen, right? So that kind of stagnated or kind of froze the market a little bit. On top of that, now you add the fact that rates still being where they have been, and mid sixes or above or higher in some instances. People's buying power also has been limited. So now we're seeing a situation where we're getting a little bit pickier of a buyer, which kind of shifts the scales a little bit, where there's not enough inventory, and then now the buyers are saying, well, there's not enough inventory, interest rates are high, we're going to be super picky about the properties that we make offers on, or properties that we buy, which kind of creates this influx in the market, which it's been interesting to see. For nothing else, it's just been interesting. And one of the things that we've been talking about with people is, I was talking to this friend of mine who's a economist, finance guy, and he was saying one of the factors, and he's an older gentleman and he's been in the business for 40 years. One of the things that we do in finance and econ and just all of this, this world, we look at trends and we analyze trends, we analyze the bell curves, we analyze charts and graphs and all the boring stuff that a lot of people don't like me talking about. But we focus on trends a lot of times, and trend lines, and where are our resistance levels, and where what are we pushing through, and we're looking at patterns within all of this, because a lot of this is cyclical. A lot of things have cause and effect, right? And if you do this, if A, then B, then C will be the outcome, right? Or in the way things operate is usually pretty standard and pretty straightforward. This year's been one of those that all of us have been kind of shaking our heads, scratching our heads. Sorry, where it's like, well, this is happening, and this is not happening, and it's been a kind of a change. So it's just been a very interesting year when it comes to that stuff. Housing construction has slowed down. There's uh, housing starts have stayed pretty consistent, um, but and then we've had situations with, like, with the tariff situations where cost of goods and materials have gone up. So what without getting into the weeds way too much, but when somebody uh, uh, forecasts and is creating like a subdivision or a big construction project, they're forecasting their material costs, their lumber, certain fixed goods that they need to purchase for the next 18 months to 24 months, and they're buying a certain chunks at a time. And a lot of these guys will buy in the futures market, so they can lock in prices for the extent of their project, which a lot of these guys will do. A lot of the smaller builders don't have that leverage to be able to do something like that, so they're forced. So they're the market has a big impact. And then when you're talking about 25-30% tariffs on certain goods, and then you factor in the fact that a lot of these construction projects are on a super razor thin margins as it is. It's caused a lot of the builders, developers, to either pump the brakes. And then you get the builders who had already started building, and the properties are coming to market. Um, Now you're getting into situations where clients where we were forecasting, well, the rates would be at this point, they will be able to afford these, 700,000 $1 million homes, or now they're not, because the interest rates have gotten a little bit higher. So now you have an oversaturation in certain marketplaces where these builders have become their own competition. They're flooding the market, so they've had to slow down their building and being able to say, look, we're not going to build to this same speed, because we need the economy to catch up, right? And so there's a lot of different factors that kind of play into this. All to say is I mean, it's still been a strong market, strong year, right? And I think in real estate, we always make our own luck, right? We see what's been thrown out there, and we see the factors, and we're looking at the situations that we're coming across, and then how do we take advantage, or how do we see opportunities? And that's one of the things that I've always tried to teach people, is that get in front of this, be educated, do your research, learn as much as you can to see where the opportunities lie. We're seeing a lot of kind of people transition away from the commercial real estate side of it, in the sense that post COVID, a lot of companies went to work from home. So you saw a lot of these Class A buildings, like office buildings or whatnot, being empty, right? Are you seeing a lot of these companies that aren't expanding workforce in that aspect of it, or going offshore, and bringing outside labor in? So you've seen a lot of different situations like that, where in the commercial space, right? So how do we use that information wisely? Well, I know a lot of clients that have seen that dip, right? And what do they always teach you in investing? You buy the dip, right? So we're seeing a slight dip in the commercial market. We can all forecast, or most people are forecasting that it's not going to be forever, right? That commercial market's going to end up picking back up, and we're already seeing it. A lot of big companies are going back to office. Everybody's starting to kind of push that back again. So now we're seeing again that curve, trending upward in the commercial real estate side of it, where you're seeing anybody who bought the dip and was able to get in and maybe to purchase a commercial property that maybe was a little bit distressed, or had been vacant for a year or two. Now you're seeing greater opportunities, right? So that is the key, and that's one of the things that I wanted to kind of just talk about today. Is one of the things that I'm kind of always preaching is just being aware of the opportunities, being aware of the marketplace and what's happening. Where we're forecasting rates to be. We're going into 2026 right now. Let me back up. In the end of 2025, right now we're potentially still seeing one more interest rate drop. We have seen the Fed in the last couple of cycles reduce the Fed funds rate by a little bit. Hasn't really impacted the mortgage market too much. without getting overcomplicated in it, the capital market side of it and the secondary market already sees that, so they start pricing that in ahead of time because we're operating on a little bit of a future. So we're taking a guess of where the market's going to be, and we already know, hey, we're going to see a quarter point decrease in the next quarter. So they'll start adjusting their margins to affect that. So you don't see a huge drop. The only times you ever do see kind of a major drop in interest rates is where you see a 100 basis point or a 1% drop in the rates by the Fed, which not very common, and I don't foresee something like that happening in the near future. Right now I think we're forecasting, again, like I said, end of 2025, quarter point drop, maybe seeing another half a point to 3/4 of a point over 2026. And I think there's still some data to come out to tell us where that's going to go. So I don't see a whole lot happening in that aspect of it. So what do we do as real estate investors or just regular folks that are trying to purchase a home? Like, what does that mean? And so I always tell people, one of the biggest things that realtors were telling people for the last couple of years is they were saying, hey, you know what? I forgot what was the cheesy line, and they would say, date the rate, marry the home, right? They're saying, so if you love the home, buy it. Don't worry about the rate. Rates will fluctuate in the next couple of months. You can refi. And as much as I do agree with that to us in a sense, right? That yes, that home is never going to be as cheap as it is today. So if you have an opportunity to get a good deal and you have an opportunity to buy the home you want, and the rates are more expensive, it's okay to do so. My caveat is assume that rate isn't going to change for a while. And as long as you're comfortable and you can make that mortgage payment and you're not overextending yourself and you're not putting in a situation where you're struggling to make that payment, you probably shouldn't be buying the property, right? And that's just me, and that's the way I like to educate and consult people. It's I've heard a lot of stories of realtors who said, hey, go ahead and buy it in 6 months, you're going to refinance, rates are going to be a lot lower, you're going to save money, and they didn't. And now you got these people that are stuck in these properties that yes, they can afford it, but they should not be in, right? And they're just hoping for that reprieve. We've done a couple of refinances for some clients of ours, just because literally we saved them $100 or $200 a month, but they were like, let's just do it, because they were that tight, hoping and praying for that rate to drop, and they hadn't seen it. So it's a tough thing to swallow. So don't get so enamored with the fact that, hey, you know what, rates are going to come down, I can afford it. And even if you can, even if that is a situation that will most likely happen, don't bank on it. Go with worst case scenario and feel comfortable with that payment for as long as you need to, because if you do get in that situation, it might be an issue. Another thing that a lot of the conversations that I get, and I've been getting it for the last, I don't know, probably say 2-3 years, is people asking me, oh, when is the market going to crash? We're expecting a crash. When is this going to crash? When is this going to crash? And then that's when I'm going to buy my property, because I'm waiting for the crash. And I've stayed to this, and I continue to stay to this. We're not expecting a crash. Don't expect property values to come down anything drastic unless there's some unforeseen, unknown, catastrophic, something out of the ordinary, which it's impossible to forecast. But based off of the economic trends, based off of inflation where it is, based off of unemployment numbers where they are, based on where the rates are, we're not going to see a crash. Yes, if you go hyper local, there is a few markets where we're seeing some really depressed markets, and those are just because those are, again, hyper local markets that created their bubbles. And we can get into that. Austin, Texas, a couple places in Idaho, some places in Florida. There was the prices there jumped to a point where it was not sustainable. It was not is not a market that sustains those prices. And it was just, um, I don't even know how to say it, but it was just, people were excited about something. And it's like when like crypto or some, everybody kind of bumps the price up because they're overly excited about it, the hype. So those markets where we are seeing some pretty drastic drops, and I think we will see. And there's again, will be continue to see that. Um, but overall, I think if you look at as a nation overall, we're not forecasting any major drops in the marketplace. Again, will certain markets drop? Yeah, maybe, but they still won't be anything extremely drastic, right? But so that tells you a lot about how you go into the year and how you create your investment strategies. If you were sitting on the fence waiting for these prices to drop, it's probably not going to happen, right? If you've owned property and you're afraid of doing certain things because, oh, what if the prices drop, or what if my value drops, my equity gets decimated. We're still not going to see that. We're going to continue seeing a maybe less strong growth, something like that. I'm not sure if that's proper English, but it's not going to grow as fast. But we're still anticipating growth. We're still expecting a robust market. In order for us to see any major change in interest rates, unfortunately, we'd have to see, a huge bump in the unemployment numbers. In order for rates to come down, we'd have to see, massive layoffs in a lot of different industries. I don't see it happening anytime soon. At least politically, they won't allow stuff like that to happen right now. So I think it, without getting too boring into this stuff, I think 2025 has showed us that we have to be adaptable. We have to be um, always head on a swivel. We have to be always looking for opportunities, cautious but aggressive at the same time, if that makes sense. Picking our spots, looking at where and when, being able to analyze markets, being able to analyze, um, you know, don't hear the noise, don't hear the news, speak to professionals and talk to people who actually know what they're talking about. And how do we create some investment strategies around your needs. Don't just follow the crowd. It's is not a time to follow the crowd. Be adaptable, be disciplined about how you invest and where you invest. Or even for your own self, right? Meaning your home. And is it time to buy a new house? Possibly. Is it time to upgrade? Sure, why not? It's just doing it the right way. Speaking to someone that can help you create a strategy around selling your property or renting out, and how do we finding an assumable loan. There's different ways to approach it. Using the tools to our advantage. Last week, or 2 weeks ago, we talked about AI. Using all those tools to being able to really make sense of the markets and some forecasts that are happening. Look at trends. Look at, there's a ton of different things that we look at, or at least that I do myself. And how which markets are growing. I just that's part of my job is just talking to everybody, every day about different projects that are going up around the country and what's happening. What's happening in New York right now. What's happening in the luxury space. I'm seeing a big influx right now, with even lenders looking to finance these huge multi-million-dollar projects. Where maybe about a year and a half ago, they were very very bearish on that. They were a little bit tighter on the purse strings with some of that. So what are they seeing? Are they seeing that, oh, you know what, these multi-million dollar, 30-40 million dollar homes, they're selling again, or there's going to be a market for that. So there's obviously something to be said for that. There's a lot of, I know the Airbnb world was for a few years took off, and we're seeing a lot of compression in that marketplace, right? People are not um, you know able to Airbnb and use that business model as much as they were a few years ago. Certain cities are coming up with restrictions. There's a lot of things. People aren't traveling the same. It's whatever your investment strategy and the route you want to take. um, I'm a proponent, or I'm a believer in, there's money to be made in all aspects of them. It's just how you do it and how you approach it. and what tools you have at your disposal, who's on your team, and how you get the job done. I think we can do something successfully in every aspect of it. It's just doing it the right way. So it's kind of it. That's all I got for today. I think we're in for a ride for 2026. I think it should be interesting. I will dedicate another episode to just maybe some more forecasts related. Today was just kind of a recap and what we've seen with 2025 and how it's been a roller coaster of emotions and it's taken us through it. But we're here. We've done well, and we live to fight another day. So appreciate you guys listening, and I'll talk to you guys soon.